Hi y'all. In this video I'm going to review the notes on income tax. As you read earlier, I'm just going to reiterate this. The gross income refers to certain monies that you bring in your household. These would typically be things you get in a paycheck or sometimes also interest earned at a bank, stuff like this. And as we go through these terms, I want you to pay attention to some things that may help you to understand what these concepts are talking about. These are just names. Gross income is the name they give to a certain thing for us to be able to compute income tax. When I give you these amounts in this class, I'm going to tell you the gross income is blah. I'm not going to ask you to distinguish what those things are. When you go to an income tax preparer, a lot of times the hard parts of doing your taxes involve figuring out exactly what is gross income, what's an adjustment, and that sort of thing. In class, we'll look at this a little more, but I need you to kind of get a basic idea of what these things are, and then we'll look at using them. Again, gross income are just monies that you bring into the house, just money you make at your job. Adjustments to income. Now, these are things that legislators have come up with as a way to kind of give you credit for doing certain things. One of the adjustments to an income is an educator tax credit or educator tax adjustment, in which this will subtract off of your gross income to lower the amount of taxes you'll have to owe. There's also an exemption. An exemption represents, well, it's really basically the number of people that live in your household, and I'll talk about this a little. We're not going to be as specific as the IRS is, but the total, you will be able to subtract off from your taxes, from your income, some amounts based on the number of people that live in your household. And that's what the exemption idea gets at. With deductions, you have two possibilities. There's what's called an itemized deduction, and that's a listing of certain types of deductions that you get tax advantages for. Or you can take a standard deduction. In class, what this will look like is I will tell you the total of your itemized deductions, and you will have a table on which you can look up the standard deduction. And the goal for you as a taxpayer is to take the higher of those two deductions, the higher of the itemized or the standard. The reason for that is you're going to subtract this off of your income before you compute your taxes. So you want to subtract off what you can. In computing your taxes, you can use a tax table to do this, and this is what we're going to do. I'm going to go through this in some examples, so we'll get back to that, but you'll see that as we go through. All right. The other thing to pay attention to are credits. So how credits work are credits subtract directly off of the amount of tax that you owe. And let's look at the tax calculation, then I'll go back to those definitions briefly. I'm going to deal with 3 steps in calculating your income tax. The first step is to determine your taxable income. Your taxable income is your gross income minus the adjustments, minus your deduction taken, minus the number of exemptions you have times the exemption amount. In 2011, the exemption amount is $3,650 per person. Alright, so again, to compute your taxable income, you take your gross income, all the money you earned, minus the adjustments. These are again amounts that the government has decided you can subtract off of your gross income because they think of it as something good. The student loan, there's some student loan interest things that work out to be adjustments. You subtract off from that the deduction you take, which is always the higher of the itemized or the standard deduction. And then you subtract off the total of the number of exemptions times the exemption amount. That gives you your taxable income. That's step 1. Step 2 is to determine the tax, which we will get from the tax table. And I'm going to call this in class the tentative tax. So step 2 gives us the tentative tax. And step 3 is to subtract the credits from the tax. Importantly, you want to pay attention to the fact that the credits come last. Now, to kind of go through this again, you start with your income, you subtract off the exemptions, adjustments, and deductions. Then you do some calculations with the tax table, and then after that, you subtract off the credits. You may notice you have adjustments, exemptions, deductions, and credits, which all seem to do a very similar thing. And that's kind of confusing. And that is kind of confusing. And that's entirely the fault of the legislators who came up with all of this stuff. It's very complicated for no particularly good reason. But this is how it's done. So we're going to focus on the fact that this is how it's done. Again, in class, I will tell you the gross income is $50,000. The adjustments are $4,000. That will not be something you have to come up with. You will need to know the process for doing this. And we're going to go through several examples in this video, and we'll go through some more in class, and we'll go through some more as we get closer to the review, and you'll see some in your homework. So after doing this a few times, it gets more clear. But there are several terms which in everyday usage mean very similar things that have a different technical meaning here, and I don't need you to know the technical meaning, but I do need you to know how to use them. Alright, so let's go on to some examples. In your notes, you have that PDF. Alright, before I go on with the rest of the problem, I want to reiterate that you need to have these notes out as you're going through the video, and in particular, you will want this tax rate schedule out, and I'm gonna go through it, and it looks kind of like this. Let me move it a little bit more. But I'm gonna get back to doing the problem. Make sure you have this out with you as you watch the video. In example 4, we're asked to calculate the income tax owed by a single woman with no dependents with the information given. The first step in this is to calculate the taxable income. Now the taxable income was the gross income minus the adjustments minus the deductions, minus the amount due to the exemptions. Now, I kind of think of this as GIA'd, but whatever works for you. Alright, so to do this, we'll notice the gross income is $52,000, because it says that. The adjustments are $4,000. Again, it says that. The deductions, now this we need to be a little more careful about. The deductions are based on the higher of this standard or itemized, so I'm going to write a little max here. So this is the maximum of, well, to figure out what the standard is, we need to reread the problem a little more carefully. We're asked to calculate the income tax owed by a single, that's important, woman, that's not important. The tax code is actually gender neutral. It doesn't care if it's single, if it's a single man, single woman, doesn't matter. And in particular, let me point you to the tax rate schedule which you have, which lists some things over on the right that are typed out, which include the exemption amounts and the standard deductions by filing type. There's going to be 3 filing type or filing statuses we'll be concerned with in this class: single, married filing joint, and head of household. There are some others, but we're not going to talk about them. And I will stress to you, in the question it will say single, married filing joint, or head of household. Head of household has a technical definition which I'm not going to dwell on, but it'll say in the problem which of those things it is. Since this is a single person, the standard deduction is $5,700. So that's what I'm going to care about here. So I'm going to find the max of $5,700 or the itemized deductions. Here, the itemized deductions are listed here. In this class, I'm just going to tell you things that would count as itemized deductions. So we're just going to blanketly assume these numbers were possible deductions. In reality, that can sometimes be a tough calculation to determine, and that's why the texts get difficult, is figuring out the answers to these definitions. But adding up those numbers, I should get a total itemized or listed deduction of $12,100. You want to take the maximum of those two, which here is clearly the $12,100. Lastly, I need to take care of the exemptions. This will deal with, first, how many people live in this house? Well, single woman, no dependents, that equals 1 person. So there's 1 person. The exemption amount for 2011 is $3,650. That will change many years. So adding up these numbers, 52,000 minus 4,000 minus 12,100 minus 3,650 gives me a total taxable income of $32,250. That's step 1. Now on to step 2. We're going to use the tax table. Okay, so again, you need to make sure you have this tax rate schedule in front of you. First off, we're using Schedule X since the filing status is single. That's toward the top left of it's kind of the gray shaded area. I'm going to be focused on the first 2 columns and the percent amount listed in the middle right column. And this is how taxes work. Each amount of taxable income you have is taxed at some percent amount, but it varies depending on what amount of income you have. For a single person, the first $8,375 of taxable income is taxed at 10%. Then the income between $8,375 and $34,000 is taxed at 15%. The income from $34,000 to $82,400 at 25%. The income from $82,400 to $171,850 is at 28%. From $171,000 to $373,000 or so at 33%, and thereafter at 35%. But this is very important, and this is something I'm going to stress in class. I'll go back through this. The first amount of income is taxed at 10%, the next amount at 15%. Even when you move into a taxable income like we have here of $32,250, there will be a part at 10% and there will be a part at 15%. And we're going to look at how that works together. So the tentative tax here will be 10% of the first $8,375 plus, well, since this amount is less than $34,000, that's important. In fact, it's between $8,375 and $34,000. We're going to have some at both 10% and at 15%. The amount at 15% will be the difference between $32,250 and $8,375. So that's going to be 10.1 times 8375, running out of room, really running out of room, plus 0.15 times that amount right there. And my calculator is dead, so I'm going to do this by hand. This should be 23,875, giving you a total tentative tax when you multiply these things out and then add them up of $4,418, and I believe I'm reading my writing correctly, 75 cents. This is your tentative tax. That's what you get from using the tax table. We're going to go through this again in class, but please try to rewatch this if you're not following this. This will seem strange to a lot of people, but this is how this works. Let me point out here, this is somewhat important. Those amounts that are being multiplied by each of the percentages have to add up to the total taxable income. That's very important. Those amounts have to add up to the total, in this case, of $32,250. That's kind of the point here. But again, some of the taxable income is being taxed at 10%, some of it at 15%. Now that was step 2. I apologize, I didn't have quite enough room for all of us very nicely here. The tax owed is the last step, and it's by far the easiest. You take your result from step 2, in this case the $4,418.75, minus the credit. The credit comes off last. And this gives us a result of $3,918.75. So, we did step 1. We subtracted from the gross income the adjustments, deductions, and exemptions. Then we used the table in step 2 to determine the tentative tax. And in step 3, we subtracted off the credit to give us the tax owed. Now I want to stress something here. That last dollar of income was taxed at a 15% rate. That is, if this single woman earned one more dollar in income, she would have paid 15 cents more in tax. Another way to look at this is if she had one more dollar in adjustments, she would have owed 15 cents less in tax. Same for the deductions. One more dollar in deductions, 15 cents less owed in tax. One more dollar of exemptions, 15 cents less owed in tax. Now, let's look at the credits down here. Those were subtracted off from the taxes, from the tentative tax we got. What that means is that each dollar of credit subtracts an entire dollar off the amount of tax owed. The credits are fundamentally different than the adjustments, deduction, and exemptions in that way. Again, $1 in credit subtracts off $1 from the taxes owed. That's a substantial difference from the adjustments, deductions, and exemptions in how those work and in what they mean. And that's something important I'm going to stress again in class. Please review this example again. I will probably do example 5 in class to start off class on Monday when we meet again, and we'll go from there. Hope this helps.